Welcome to the MUFG Global Market Asia podcast. I'm Lin Li, head of the MUFG Global Market Asia research team. Today is December 15, 2024. The following podcast is for informational purposes only. It's intended for professional investors and eligible counterparties, not for retail clients. Any content should not be regarded as offer to conduct investment business or investment recommendations. In today's episode, I will share the main views of our newly published Asia FX Outlook 2025, Navigating Asia FX Market in Trump 2.0. We highlight several main themes which would govern Asia FX movement in 2025. These themes include impact of Trump's trade policies on Asia economy and FX, the levers to stimulate China growth, implications of semiconductor outlook on Asia FX, the impact of Fed's easing cycle on Asia FX, and etc. Compared with 2024, for the upcoming 2025, against a backdrop of heightened uncertainty around Trump's economic trade policies and geoeconomic landscape, Asia FX is rendered much harder to read. Even as the Fed cuts rate furthermore from elevated levels, relief for Asian currency may not so evident. Trump's trade policy and tariffs would be a key factor for Asian currency movement in 2025. Tariffs in Trump's second term likely are more aggressive compared with what happened in his first term, when it mostly happened on U.S. imports from China goods and a narrower U.S.-China trade war. Going forward, we expect Trump to increase U.S. average tariff on China products from current 19.3% to 40%. Additionally, with Trump's strong promises to rebuild U.S. manufacturing sector, Trump likely uses tariffs to reduce U.S. global trade imbalances with more countries. We see the possibility of tariffs on Vietnam, South Korea, and Taiwan, and tariffs on certain products globally as well. During the U.S.-China trade war, there were bystander Asia economies benefiting from U.S. shifting demand. For Trump's second term, the threats of tariffs on some Asian countries and certain products will bring disturbances to production and investment, as well as deflationary pressure in the near term, despite the more significant tariffs on China will eventually benefit these economies in the long run. For the 2025, another key factor for Asia's FX is China's performance and ripple effects of tariffs on China. Due to the large exposure of Chinese economies to China demand and China investment, we see strong Chinese government's intention to stimulate growth, and we see the levers to achieving that in 2025. In addition to increasing the consumption subsidies, structural fiscal policies working on improving people's livelihood would be an important approach in revitalizing domestic demand. We expect a mild growth deceleration to 4.5% for China growth in 2025 from this year's 4.8% growth. A slower global growth and particularly tariffs in the incoming Trump administration are likely to bring headwinds to Asia growth in 2025. Philippines, Thailand, and India could be an exception due to support from fiscal spending and domestic demand. Our Asian FX forecasts assumes a further 100 bips Fed policy rate cut by the end of next year, and the US dollar to peak in Q1 or Q2 before its weakening in the rest of the next year. We expect tariffs to bring large depreciation pressure on CNY. Export-oriented currencies with large exposure to Chinese economy, such as won, Malaysia ringgit, Singapore dollar, Taiwan dollar, will be more negatively affected, while Philippine peso and Indian rupee will be relatively more insulated. We expect some reprieve for Asian currencies in second half of next year on a possibly weaker US dollar. The AI boom will likely help reduce some of stress on Taiwan dollar and Korea won against the US tariff hikes. Some Asian currencies are already at a quite cheap level against the dollar, with potential more upside on US dollar itself and our call for further weakening of Asian currencies. We expect more frequent Asian central banks' FX intervention in the market in the year ahead. The possibilities of Asia currency crisis is still low, as major Asian economies have robust external buffers with manageable external debt and sufficient FX reserve to prevent it from happening. For the US dollar CNY pair, tariffs and potential wider negative China-US yield spread would push the pair up to 7.5 in the middle of next year and end the year with 7.4 due to a weaker US dollar till the end of next year. For US dollar INR pair, we forecast the pair rise steadily towards 86 level in 2025, with INR outperforming Asian currencies in the first half of next year. For the US dollar IDR pair, the economy's deepening trade linkage with China makes IDR vulnerable, but the currency depreciation will still be relatively modest, giving Indonesian economies still more domestic-oriented. For the US dollar Malaysia ringgit pair, the ringgit is likely to weaken in the first half. However, domestic structure reform can help reduce some pressure for the currency. For the US dollar Philippine peso pair, we expect the pair to reach 59.7 in the first half of next year as US dollar strengthens. We see the pair decline to 58 by the year end on boost from midterm election spending and surge in the FDI approvals. For the US dollar Sing dollar pair, we expect Monetary Authority of Singapore to reduce the appreciation pace of Sing near and see the pair to peak at 1.38 by the end of first quarter next year. For the US dollar won pair, a weak Korean economy and its large exposure to China would weigh on won, especially in first half. Pressures on won could also come from a wider negative government bond yield spread with US. Potential tariffs as Korea among countries that the US has large trade deficit with and persisting ODI investment. That said, dollar strength moderation in second half and eventual inclusion of Korean government bond into FTSE Global Bond Index starting November could provide some support for Korean won towards the end of next year. For the US dollar Taiwan dollar pair, buffered by the sound domestic demand and AI-related exports, we expect relatively mild Taiwan dollar depreciation in first half before reversing some of the loss in the second half. For the US dollar Thai baht pair, after the rise in the first pair, an eventual narrowing of interest rate differential versus US, a further tourism recovery and fiscal stimulus via the digital wallet program should partially cushion some of pressure on Thai baht in the 2025. For the US dollar Vietnam dong pair, we forecast the pair to trade closer to 26,000 in 2025 due to potential scrutiny on Vietnam's exports and China-linked supply chains. Nevertheless, we are hesitant to be overly bearish even as we acknowledge the left tail risk. For one, the central bank is likely to employ a range of tools to manage currency weakness. Additionally, we still think Vietnam still has significant comparative advantage in manufacturing. Having said the above, there are risks to our forecast, including the magnitude of Trump's tariff, how other countries will respond, how effective China's stimulus policy could be, as well as geopolitical risks. Thank you for listening to your MUFG Global Market Asia podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you subscribe to your podcasts. Contact your MUFG sales representative for more information. Check back again for more insights from our global market research team.